Good afternoon, everybody. I would like to welcome you to the first of many lunch and learn sessions that we're going to have. I am really excited that you've joined us and look forward to answering any questions that you may have. I do have a co-host, Melinda Payan, who is going to be answering the chat and manning the chat while I am doing the webinar. So if there is something that you need, just go ahead and put a message in the chat. And if it's for me, I will answer the questions after the webinar is over, or perhaps throughout the webinar. So I'm really excited about what we've started here, the Lunch and Learn series of episodes is really going to be geared at education, discussing strategies for realtors, specifically realtors in Florida, keeping you updated on what is going on with the pulse of the mortgage industry and the changes that are constantly happening in the industry. For example, one change that recently happened is that there is a temporary loan amount increase on the conventional loan limits. It previously was $726,200. Now most lenders have temporarily increased it to $750,000. This is for the new Fannie Mae conventional loan limits. Historically, the lenders are doing this in basically preparation for what will ultimately be the final announcement that comes out at the end of the year from Fannie Mae with the correct or exact loan amount that they're going to increase it to. But because the loans now that are closing will ultimately be delivered to Fannie Mae in the first quarter of next year, this is why they're doing it. They're allowing some leniency. So that is just one piece of information. But today what we're going to discuss really are what is going on with interest rates and what do we think is going to happen with the market forecast, and how can you work within the current environment or increase your production, your real estate production within the current environment, and how do we really address the questions that consumers are asking about waiting. You hear that a lot. So should we wait for the rates to go down, or is the market going to crash, or various questions that the consumers ask. And I like to give you the ammunition and the information really to be able to convey to the consumer in an educated way, and also in a way that really gives them a good comparison of what we are going through now compared to many years ago, because you also do hear that is the market going to crash and what's going to happen. So first, we're really going to just talk a little bit about interest rates and have just a basic understanding about what affects the interest rates. Just to kind of give you a brief overview, I'm not going to go into economics 101, but I want you to understand that the Federal Reserve does not directly control mortgage interest rates. The way that the mortgage interest rates work is that they're kind of loosely tied to the 10-year Treasury bond. This has always kind of been the case since the Great Depression. So whatever happens with the 10-year Treasury bond basically dictates what's going to happen with the mortgage rates. So there are some times where the Federal Reserve does not lower interest rates or raises rates, and we see kind of an inverse thing, an inverse reaction. So there may be times where interest rates are increased, but the market thinks, oh my God, that's wonderful that they didn't increase it anymore. And because of that, you may see the rates actually go down on a day where the Federal Reserve maybe had increased the interest rates. Or also it could be the reverse of that, where the Federal Reserve lowered interest rates and the bond market or the investors out there perceived that the lowering of the interest rates was not enough. And so the rates actually get worse. So it's all really dependent upon what the 10-year Treasury bond does. And kind of as a rough guide, usually mortgage rates end up being about maybe 1.75% higher than the Treasury bond. So that's just kind of a rough guide depending on where the market is. So another thing that dramatically affects mortgage rates is, and yes, as the Federal Reserve increases rates, of course, the Treasury bond has an effect from that. So there is an indirect relationship to what happens with mortgage rates. Another thing that affects interest rates is the sale of Treasury bonds out there in the market. So every quarter, the Treasury Secretary, Janet Yellen, comes out and basically discusses or announces how many Treasury bills that have to be sold in order to continue to fund the debt of the US. And sometimes there's more that have to be sold, and sometimes there's less, depending on the inventory. We're kind of at a time right now where there aren't as many buyers as there were a few years ago, because the federal government and Fannie Mae and the banks were much bigger buyers of their own Treasury bonds, or the federal government of their own Treasury bonds. And as a result, the rates obviously were a little bit lower because there was more demand. Right now, there isn't as much demand for the Treasury bonds. So what happens is that when there isn't as much demand, the interest rates or the yield, what they're paying, go up a little bit higher. And then as a result of that, mortgage rates go up as well. So you could see that happening even if the Federal Reserve does not increase interest rates, which could potentially happen coming this next quarter that comes out. Also, in recent history, China was a really big buyer of our Treasury bonds, but they've kind of laid off a little bit because they're dealing with their own economic issues. So right now, that's a little bit of a background on what affects mortgage interest rates. But the bottom line, what we want to know is, when are things going to get better? What do we see happening here? And where are rates headed in the short term versus the long term? And what I mean by getting better is, are we going to see some relief with the interest rates coming down? So there's a few meetings coming out before the end of the year. There's a meeting from the Fed on November 1st. And that meeting, they don't technically need to make a statement or make a decision on what's going to happen with interest rates. So it really does allow them more time to see what the results of their increases in interest rates have affected the economy. And so we won't really hear from them until December. There are a lot of people that feel that the Fed is done with increasing interest rates, or that has maybe one more hike left in them. But overall, the top economists out there are generally believing that we're at the end of the process, if not completely done already. We're very, very close. So it's really interesting if you look at some of the forecasts from the Mortgage Bankers Association, which is really one of the key associations out there. They have some very interesting projections. So first of all, they're actually projecting some negative growth for the first 2 quarters of next year. So they're thinking that what the Federal Reserve has done will slow things down quite a bit. It will slightly increase unemployment, and as a result, they think that we will see their statement is that we will see 3 Fed decreases next year, with rates ending up in the high 5s by the end of next year, and that the rate decreases could start anywhere from March to July, depending upon the economic news. There's a lot of things that go into those decisions, GDP. There's a lot of things that will determine that, but they feel very strongly that we are going to see rate cuts into next year. So they think that as a result of some slight economic slowdown, that the government is going to have to step in and allow some liquidity into the market and lower the interest rates. And this is a historical thing. This is what always happens in the history of the Federal Reserve. They raise, and then it's almost kind of like, I like to use the analogy of like a car with a brake, that you really hopefully could have stopped a little bit earlier than when you stopped. And sometimes it ends up causing a slight decrease with the economy. But we're certainly not looking for a crash. We're certainly not looking for some kind of dramatic situation. We are just looking at a small decrease in the economy. And so as a result of that, we're actually seeing Fannie Mae project about 20% higher sales for next year of real estate. They believe that loan originations and home sales are going to increase by about 20% next year. And what's interesting is that Freddie Mac is projecting the average rate of appreciation of homes across the country. Now, we're going to talk about Florida here very specifically coming up, but Freddie Mac is projecting a global appreciation somewhere between 1 to 6%, 1 to 6.5%. When I say global, throughout the United States, obviously. So what is different in Florida than the rest of the country? Many of us already know what the differences are from the perspective of we've been doing real estate in Florida for quite a while. Some of us are new that are listening and maybe not as aware of some of the changes. But it's very interesting when we look at some of the statistics of some of the key associations out there. Like, for example, the National Association of Realtors came out in July of this year and actually announced that Florida was the strongest real estate market in the entire United States. It was very interesting to see their projections. They're saying that the average rate of appreciation of owning a house in Florida in the long term is, well, I would say within 5 to 10 years is roughly around 15% a year on average, or 15% over a period of time over the 5 to 10 years. Now, that's pretty conservative because the appreciation rates are actually a lot higher than what we've been seeing. But what's interesting is that they went on to say that 1 in every 2,470 homes, only 1 out of 2,470 homeowners are in foreclosure. And that only 1% of homes in Florida are underwater. That means 99% of people in Florida have equity in their homes. And so it's very interesting to see the statistics here in Florida compared to the other states out there, because we're in a very strong market. We also have a very large cash market, which is one of the reasons why our market really hasn't been affected as immensely by some of the high interest rates as some of the parts of the rest of the country. Yes, we've definitely seen a slowdown, but we're still trucking along very good in comparison with the rest of the country. Right now in the state of Florida, between 35 to 53% of buyers in the state of Florida are paying cash. That's a really high percentage. That's much higher than the rest of the country. Perhaps there's a state or two that could be close to that, but we have probably one of the strongest cash markets out there. And when you look in the metropolitan areas, in the South Florida areas or in the Tampa areas or the higher metropolitan areas, those percentages are even really higher. So then how do you work with a financed buyer when you're competing against so many cash buyers? And that's really an important question to ask. We actually offer a product called a TBD underwrite, where we can actually get a file in underwriting without a property picked out yet. So we actually underwrite the borrower's income and credit and assets and all of that stuff. And we actually can get you a loan commitment for your client, only contingent upon the appraisal, the insurance, and the title. So you are actually walking in to place an offer on a property with a loan commitment in hand, conditioned upon the things that are particular to the property. And that we have found that that has really helped our clients to be able to compete against such a strong cash market, because of the fact that they're not just pre-approved, they're actually able to walk into a situation with a loan commitment. And like I said, those percentages of cash buyers are much higher in the metro areas. They're actually closer to like 50%. So what is going on and how can we do some comparisons with clients on a level that is a very simple explanation as to what they'll understand. So first of all, I know we all hear this all the time. Oh, I'm not sure if I can afford a house, or I'm not sure that I should buy right now. Maybe I should wait till the interest rates go down. So as all of us know who are on this webinar, there is very little inventory out there right now. There is a little more inventory than there was perhaps last year, but for the most part, there's really very low inventory. Once interest rates start going down, we're going to see a tremendous amount of buyers jump back into the market. That is going to really make things even crazier with the fact that there's going to be many more buyers back in the market. As soon as we start to see a decrease in interest rates, it's going to immediately trigger people to start looking and start jumping in. I see it. I know my loan officers see it. We probably have a ton of people who are agents that we've talked to that they hear that all the time. So what really are we looking at here as far as like real numbers? Let's kind of take a look at that. So if somebody were to buy a $500,000 house and put down 3%, let's say they're a first-time home buyer and they're putting down 3%, because you can do a conventional loan. You can do a Fannie Mae conventional loan, not an FHA loan, with 3% down if they're a first-time home buyer. What would their payment look like on average compared to what they would be paying for rent? And I have also a $600,000 price range. So I just kind of pick like an average medium price range to do some comparisons. So on a $500,000 house, they probably would be looking at somewhere of around a $4,600 or $4,700 payment. And on a $600,000 house, they probably would be looking at somewhere between a $5,200 to $5,400 payment. So it's either lower than or comparable to what they could be possibly paying for rent. I know that I tried to look at some rental comps in that price range, and let's say it's a 3-bedroom or 4-bedroom house around 2,200 square feet. Depending on the area, the rents were all over the place. They were from $4,000 to $5,800. So I just kind of picked something in the middle, which is somewhere close to $5,000 a month. And in many cases, the rent and the mortgage were the same. The difference is that, let's say people wait and they wait until the interest rates come down, and now that $600,000 house is a $630,000 house or a $640,000 house, or significantly higher than where it is right now. Even at a 1% lower interest rate, they're going to be paying the same payment as if they were purchasing it at the lower price right now. The difference is that they can refinance when the rates go down. So now they've locked into the price range of what today is, where there still is some, negotiation or a little bit less buyers in the market right now. So when you're working with a buyer who perhaps has some hesitancy because of the interest rates, I would really take the time to explain to them when the interest rates go down, excuse me, when the interest rates go down, there's going to be far more buyers in the market. And as a result of that, the values are going to be higher. There's going to be much more competition. We're going to see a little bit of that 2020 craziness where people were bidding over appraised value. I mean, we're already seeing that in some markets now because inventory is so low. We still see that to some respect, still, even with the higher interest rates in the market that we have, but we're going to see it in a much wider scale. The ability to get any seller paid closing costs, although it's not common right now, it's happening to some degree. It's probably going to go to very, very uncommon, or maybe not even possible when the interest rates go down. So they're locking in the ability to be able to buy at a better price now than what that they're going to potentially see coming next year. At a minimum, we see forecasts of a 5% appreciation for next year for the Florida market, somewhere between 5 to 6% appreciation. So that $600,000 house is a $630,000 house next year. So really the best thing for them to do is to buy now and then look at refinancing later. So what does that mean? What does look at refinancing later mean? It means that they should be paying as little closing costs now as possible. They should be not buying down the interest rates. They should not be doing buy downs where, I know that was a very popular thing at the beginning of the year to explain to people, hey, we're going to get a seller funded buy down and you'll have a temporary lower payment. No. If you have a seller that's willing to pay closing costs, they should use that money to pay the actual closing costs and not for a buy down, because these people are refinancing. Whoever is buying right now with a mortgage, unless they pay their mortgage off with cash, there's a 99.9% chance of them refinancing this in a year from now. Or, unless something happens with them financially and they foresee something else, that's a different story. But for the most part, there's very, very, very good odds that if all things are equal, that they're going to be refinancing in a year from now. So let's just discuss a little bit about the other big thing that we hear, which I'm pretty sure that we have heard every single year since 2011. Oh, the market's going to crash. I don't want to buy right now. We've heard that every single year. There's been news articles and there's been many, many reports of crazy stuff over the years. And I can certainly point out many of them to you where the market's going to crash, the values are too high. We've heard that 2016, 2017, 2020, we heard that. There's a lot of people that right now wish they would have bought in 2020, right? But we all heard that tremendously in 2020 just because values were up so much. And what do we tell people? How do you best address this with a consumer? The best way to address this is, why is this not 2008? Okay. In 2008, there were 3.7 million units of real estate on the market at that time. 3.7. Right now, the total number of units that are on the market, I'm talking nationwide, okay? The total number of units that are on the market are somewhere between 1.3 to 1.5. And that's up because last year was 1.2. Okay. So we're talking 2.2 million less of units or houses for sale on the market right now. In 2007, there were 116 million households in the United States, 116 million households. Now we're talking about 135 roughly million households in the United States. So we're talking, there's roughly around 19 to 20 million more households in the United States right now. So about 12 to 14% more of households in the United States. But there's 30% of the inventory that was out there in 2007 or 2006. So you've got a third of the inventory, and you have way more people out there in the United States now that are households. We're not even talking people, we're talking households. A household could consist of, a family of 3, a family of 5, whatever the case may be. We have such a critical inventory shortage out there right now that even if there was a 20% increase or a 30% increase in inventory, that would only partially satisfy the demand. So you're talking about demand being greater, inventory being less, and you are also separately from that in a different time when consumers have a tremendous amount of options. Let's just say there happens to be some economic situations where a person loses their job or they are going through some difficult times financially. Right now, you have so many different options that you didn't have in 2007 or 2008. So even if somebody is starting to have some financial difficulties, there's a loan modification that they could qualify for. There's a forbearance that they could possibly qualify for. There are many workout programs that didn't exist back then. It's not that they didn't 100% exist, because there were maybe a few small options available, but now there's actually a whole ton of options available for consumers in the event that they get themselves into a difficult situation. And most people are in a high equity position. So if they lost their job or something happens to them financially, they're still selling their property with equity in it. So for those who are hearing, what should we do? Do we think the values are going to go down? What's going to happen here with the interest rates? Talk to your consumers and explain to them, listen, guys, right now is the best time to be able to buy something before everyone else jumps back into the market. And you can refinance or look at refinancing at a later point. And then also on top of that, there shouldn't be any concerns about the market crashing or values going down. That is not going to happen, guys. It's just not going to happen. There's too little inventory. There's too many safety checks in place with financing. This is not 2008. There's a million charts and graphs that show it. And please, you can confidently speak to your consumers and explain that to them. If you just simply tell them the statistics I told you, which is there's a third of the inventory and there's 20% or 15 or 12% more households out there, just that alone should be able to explain it to people. But I know that that is a concern that's out there, and I think that it's something that we really need to address head on. So there's a few things that also Fannie Mae and FHA are doing to try to promote homeownership. For example, if you've seen the news recently, Fannie Mae is now allowing a lower down payment on an owner-occupied 2 to 4 unit property. Previously, if somebody was going to buy a duplex or a triplex or a fourplex, they were going to live in. They only had the option to go with FHA if they were working with less than 15% down. Now, Fannie Mae is allowing a borrower to purchase a 2 to 4 unit property with as little as 5% down. And remember, the loan limits for those multi-unit properties are much higher. They go into the million range. So depending on if it's a 2, 3, or 4plex, those are much higher. In addition to that, FHA made an announcement about allowing income from they're called ADUs, but it's basically an accessory dwelling unit. So let's say somebody has a guest house, or somebody has a in-law suite, or whatever the case may be. It's not technically a duplex because it doesn't have 2 meters. It's just an accessory unit that they're using. We can now use the potential rental income from that space to help people qualify. So there's some things that are being talked about from an affordability standpoint to try to help consumers to be able to get into the properties easier. There's some new down payment assistance programs that we work with. There's a 1% down program. There's a no money down program. And we'll get into some of those programs at a different session. But for the most part, there's some things that are being done to try to address affordability, because truly, especially like in the South Florida market and many other areas of the metro parts of Florida, if you're looking at first, last, and security, you're pretty close to being able to afford a down payment, assuming that we can either get you down payment assistance or there's a seller credit involved or whatever the case may be that might be possible right now. So if you have a borrower that is looking to rent and you think the rental is going to be $4,000 or $5,000 a month or whatever the case that rental amount could potentially be, send them to us. Let us do a pre-qualification and see, because there's a lot of people who have that in their head that they need 20% to put down, and they don't. They really don't. So there may be some options for those people. It's really interesting. There's some statistics out there that I've looked at that say roughly around 30% of the renters that are in the state of Florida right now have the ability to be able to buy a house and have, you know, the credit, the income, some type of down payment. And so the question is, why haven't they done it yet? And really the answer is that partially because of interest rates, they feel that there's going to be a benefit for them waiting. And then partially because they're concerned about the values. And it's up to us professionals to really educate them and explain to them what is going to happen when the interest rates start going down. We're going to see a flood of buyers entering into the market, and we're not going to really see a flood of inventory entering the market, because you've got a ton of people who are sitting at 2%, 3%, 4% interest rates. And they, you know, unless they have a life event, like they're downsizing or they're moving out of state or they're being relocated, may or may not be that motivated to sell their property. Now, you may see some when the interest rates go down say, okay, or at least we're closer to where we've been, but that is something to really address with buyers. So the bottom line is that Florida is the strongest, if not one of the strongest markets in the entire the United States right now. We still look inexpensive to people coming here from other states, even though some of us may think, gosh, this property was $300,000 a few years ago, and now it's $450,000. To somebody that's coming here from New York or California or other states or even other countries, it's to them still looks inexpensive in comparison to what they would be getting. And as far as what is going to happen with interest rates, we are definitely seeing a decline that's going to start at some point next year. I do want to mention one thing. We do get a lot of people who ask us, well, what about adjustable rate mortgages? And could that be a benefit to a client to go into a temporary adjustable rate mortgage? So it's really interesting what happens with mortgage rates. The mortgage rates that are published kind of can tell us as professionals what the lenders or the banks are thinking is going to happen. And the reason I tell you that is because adjustable rates are so closely priced to fixed rates that it's not even worth it to do the adjustable rate. Why is that the case? Because everybody thinks the interest rates are going to go down, and the banks know that there's high likelihood of these loans that they're doing right now being refinanced, and an even higher likelihood of an adjustable rate being refinanced. So there isn't much of a secondary market of people buying and selling these in the bond market. So the mortgage-backed security market, or the people that ultimately buy these mortgages at the end of the day, are really not too thrilled about buying adjustable rate mortgages. So what happens? They price them in a way that leads us to determine that it's just not really worth it for the client to save 1/8%, you know, for example, to go into an adjustable rate versus a fixed rate. The other thing that we're seeing quite a lot on mortgage rates is another good indicator that rates are going to be going down next year is when we look at a rate sheet. Generally speaking, the higher the interest rate, the more of a lender credit that we can offer a client to be able to offset some of their closing costs. However, what we're seeing is that lower interest rates, which is not common, lower interest rates are actually offering higher lender credits to assist the client. And the reason why we're seeing the inverse of that happening is the lenders are saying to themselves, hey, I'll have less of an early payoff. I'll have less people refinancing my inventory. My portfolio will not be turned over as much if I offer them a 7.25% interest rate with a bigger lender credit than an 8% interest rate. So we're actually seeing pricing have some kind of an inverse relationship, which you often see. You guys don't see that because us as mortgage professionals see that, but that's highly indicative of the lenders knowing that these are not going to be loans that these consumers are going to have long term, and as a result, they are going to really be trying to encourage a client to take a lower interest rate to be able to keep the loan out there longer. So that's kind of what's going on right now with interest rates and forecasts. There's, like I said, for the Florida market, there's a 5 to 6% forecast of appreciation, and we're not showing any signs of slowing down. And then that, coupled with the fact that we're going to see lower interest rates, is going to make it really quite a crazy market next year for buyers jumping back in. I'd like to open up the chat to see if anybody has any questions regarding anything that I've said, or how to address anything with consumers in any way in reference to interest rates and what we're looking at in reference to forecasts. I also want to let you know that going forward, we are going to have sessions that are going to be really hands-on strategy sessions, like talking about working with investor cash flow loans, or talking about specifically working with down payment assistance, or how to explain to clients about condos and the condo financing markets. And we're going to have different sessions every week. This is just more of an informational session, but we will have a lot of really great information coming weekly. So if you would like to sign up for the additional webinars, the same link that you registered for this one, you can pick and choose the webinars that we're going to be having for the rest of the year. And then starting next year, we're hoping to have some guests on from various associations, and we're going to be reaching out to Fannie Mae and Freddie Mac and seeing if we can get some of our local market representatives to speak to us also as well. And I think that is about it for this webinar. And if anybody has any questions, please let us know. Okay, let's see. I have a question here in reference to buy downs. So I think that if everybody recalls at the beginning of the year, this is like the hot topic, buy downs. And I think it maybe is a little bit still, but not as much. And for those who are not familiar with what buy downs are, it's basically where the seller is paying closing costs to be able to temporarily lower the interest rate on the client for either 2 years or 3 years. Pardon me. What that means is that, for example, they may have a 5.5% interest rate the first year, a 6.5% interest rate the second year, and then it would go to 7.5%, and then it would be remaining that for the rest of the time of their mortgage. That's called a 2-1 buy down. There's also a 3-1 buy down, where the client's interest rate for the first year is 4.5, the second year is 5.5, and the third year is 6.5, and then the fourth year it goes to the permanent interest rate of 7.5%. So what happens is that there's a cost associated with buying down the interest rate, and for the most part, it has to be funded by the seller. There are some lender paid buy down options, but for the most part, it has to be funded by the seller. So let's say the seller, you guys do a fantastic job and you're able to negotiate $15,000 towards this buy down program. What happens is that $15,000 is used, it's applied towards, it's kind of like they're covering a portion of their mortgage payment during that time period, because ultimately the final interest rate is 7.5%. So the lender looks at it like, okay, the seller is covering the difference between the interest rate for the permanent, the temporary interest rate for that year and what the real interest rate or the permanent interest rate is. So there's amount of money that it's applied towards each year. So what happens is that the first year, maybe let's just say $5,000 of that seller paid closing costs is applied. And then each year up to the fourth year, for example, this is on a 3-2-1 buy down. So each year, a portion of that money is applied. And in the consumer's eyes, they have a permanent interest rate of 7.5%. So you've got the consumer $15,000 to buy down the interest rate. It's coming from the seller. Everything sounds wonderful and great. But let's just say interest rates go down next year. And now interest rates went from 7.5% to 5.9%, which is what they're projecting. They're projecting interest rates to be in the high fives by Christmas next year. Okay. What is that consumer with that buy down going to do? They're going to refinance. And so that money that's left over that wasn't used for the remaining period of the buy down will go towards a principal reduction on their mortgage, which is wonderful and great. So they won't lose the money. But if that consumer could have used that $15,000 right now to pay all their closing costs, they would be in a much better position financially to be able to have all that extra money in the bank so that they can make it to December of next year or whenever exactly the interest rates go down enough for them to worth it to be fine to refinance. You see what I'm saying? And a principal reduction is wonderful and great. And yes, they don't lose the money, but it's a better benefit for them to be able to use that seller credit to cover all their closing costs right now. And if their payment is temporarily higher for a year until we refinance, it still gives them far more cash in the bank than them having to use that money towards partial buy down and then eventually a principal reduction. So if anybody else has any additional questions, please put them in the chat and I'd be happy to answer any additional questions that you may have. Let's see, if we have any other questions here. So we have another question here about, we hear that the Fed is not done raising rates. Why do we think the rates are going to go down? Well, yes, it's true. We could possibly see one more increase in interest rates. We're not sure. We think they're either very close to being done or are done, one of the two. But just keep in mind that the minute that the bond market or that the economists feel that the Fed really is done, that perception alone will start to lower interest rates. Just that perception alone. Remember, the Fed does not directly control the mortgage interest rates. They only control 3 rates: the Fed funds rate, the discount rate, and the prime rate. They don't directly control mortgage rates. It's the perception of what they're doing that affects the 10-year Treasury bond that in turn affects the mortgage rates. So just them being done with raising rates alone will cause the interest rates to start heading down. And the reason why all of the economists feel that we are going to start seeing sometime between the second to third quarter of next year interest rates going down is that we have already started to see an economic slowdown. We've already started to see numbers indicating that inflation is starting to be under control. Yes, there's been some recent announcements that have indicated some other numbers that are still pretty hot, but some of those numbers have the cost of fuel, and they also have housing in it. But when you look at some of the other numbers, it looks like inflation is really starting to get under control. And as a result, we're also seeing a slowdown with certain parts of the economy that leads us to believe that we're going to see higher unemployment numbers in the first quarter of next year. Again, not a crash, just basically a slowdown. And when that happens, the Fed has to step in and provide liquidity. And this is historically something that happens, that has happened so often that it's very easy to project what is going to ultimately happen next year, from at least from the economist's standpoints. But you've got some really big people, really big entities like Fannie Mae, Freddie Mac, the National Association of Realtors, projecting some really big increases in 2024. So in closing, what can you do now? Talk to your consumers, explain to them the cost of waiting. Not only will they lose the opportunity to have some negotiating power right now, they're also going to lose the opportunity of having homestead for next year. That's a whole nother thing to think about. If they close before the end of this year, they'll still be able to qualify for homestead. So we're going to close the webinar now. And if anybody has any additional questions, please feel free to reach out to me directly. You can certainly reach out to any of our loan officers. They're always available to you. Just a reminder, we have 15 loan officers. Many of them speak lots of different languages. So we have quite an international group of loan officers who are here to help your clients. In addition to that, as a reminder, we have I know we talk a lot about the alternative programs that we have, but on conventional loans, regular A paper, Fannie Mae, FHA, VA loans, we have extremely competitive interest rates. It's not very common that anybody is able to beat our interest rates, quite honestly, because we have no, fluff in the middle. We are able to provide very direct, raw interest rates where we don't have a regional person and a branch manager and a this person and a that person that are have their hands out and looking for a piece of the pie. We run a very tight ship and are able to be providing consumers extremely competitive interest rates and closing costs, in addition to all of the other alternative programs that we offer. So as always, thank you so much for joining our webinar. I'm excited about this new series that we're starting. Each week, we're going to discuss a different topic, and I look forward to seeing you on future webinars. And thank you so much for joining us, and have a great day, everyone. Bye.